this is one, Tom, where looking at the performance of that fund, I actually wince a little bit. We are fast approaching the end of another tax year and the closing of another batch of tax-efficient investing allowances. If you haven't already used your ISA or SIP allowance for this year, and you have the money to do it, of course, now is the time to act. But where should you put your money this time round? Sadly, we can't tell you that, but what we can do is tell you where other people are putting their money, including some of our elite millionaire investors. And joining me to do that is Tom Stevenson, Investment Director here at Fidelity. Tom will also be lifting the lid on some of his choices for this ISA season. Tom, welcome along. I'm just going to reiterate again at the start here, we cannot tell anybody to buy or sell or to hold any one particular investment, but we do know people are going to be sifting through possible ISA investments at this time of year. So what we're going to do today is run the rule over the lists of our best-selling funds, the best-selling funds on the Fidelity platform. Also looking at those funds that are popular among the millionaire investors, those who've built up £1 million at least in their SIP or their ISA. And we're going to look at some of your choices as well. We'll look at the reasons that those funds have been popular, why they've done well or might do well, and the risks that they're going to pose from this point onwards as well. So with all of that said, Tom, the first fund that we have to talk about, top seller among ISA investors this year, the second best seller among SIP investors. It's the most vanilla of the vanilla. It is the Fidelity Index World Fund. Tell us, Tom, why a fund like that is so popular.
Yeah, it is a very popular fund, and not just with investors on the Fidelity platform. It's a bestseller on lots of platforms.
Mm-hmm.
Two reasons why it's popular. One, as you say, it's completely vanilla, pure exposure to global stock markets.
Mm-hmm.
It tracks the global MSCI World Index, as its name suggests. And so if that's all you want, if you don't want the fund selector to be picking stocks, you just want to have an exposure to hopefully the over time upward movement in the stock market, and you want to do it cheaply. That's the second reason.
Yes.
It's extremely good value. It sells for, I had a look just before I came out, actually.
0.12,
12,
I think.
yes. 0.12%. 12 basis points in the jargon.
Yeah.
That's really
pretty
very
decent.
cheap. Yeah.
Pretty decent. And, as you said, for anyone just wanting that broad exposure, the aim of a fund like this is that you won't get more than the market, but you won't get less. And a lot of investors are happy with that kind of deal, aren't they? They'll say, well, I'm going to take my choices out of the equation. I'm going to buy this fund. It will put you into different regions of the world's global stock markets in the proportion that they make up by value, basically.
Yes, it will. And that is, and that's a point that's worth dwelling on a little bit, because some people may not have really thought through the implications of that, because the US stock market represents about 70% of the value of global stock markets. Mm-hmm. And therefore, this fund also has a 70% exposure to the US market. So that may be what you want. It may not be what you want, but it is what you will get.
Yeah.
And that's the important thing to remember.
And popular, actually, among all sorts of different types of investors. It helps that it's done quite well, because the US market has done well, and certain companies within it have done quite well. But I thought it was interesting that when we look at the list of our millionaire clients, it's on the list of bestsellers, but it's all the way down in 9th. So there's sort of plenty of options ahead of it for that type of investor. Any sort of inkling or intuition as to why that might be?
Well, I think there's a sort of intuitive logic to that, which is that if you are an active investor, you're interested enough to look into individual funds, you might use a global tracker fund like this as a sort of kind of core investment at the heart of your portfolio. But then you may think, well, actually, there are good fund managers who I think stand a good chance of outperforming that global index over time. So I'm going to have some of that as a satellite around the edge. But I don't want to put all of my money into those, essentially bets on the skill of an individual fund manager. at the heart of my portfolio, I want something that's just going to give me exposure to shares.
Yeah, so it's a tracker fund. It's not the only low-cost tracker fund we've got on our lists. I'm going to mention a couple of others while we're here. There's the Fidelity Index US Fund, does a very similar thing, but just for the US market, and the UBS S&P 500 Index Fund, both of them tracking the S&P 500 and doing it for even more cheaply than that global fund. I think 0.6% for the Fidelity version, about 0.9 I think for the UBS version. Kind of that's probably the cheapest way to get, obviously it's just the US market, but they're big companies, aren't they? And they will account for a big part of even a global index. So for quite a generalist investment, that's an incredibly cheap way to do it, isn't it?
Yes, and it's probably, I mean, I haven't looked at it from this perspective, but the performance of those is probably not dissimilar to the performance of the World Fund, given the weighting of the US within the global index. So effectively, you're getting something that looks quite similar for half the price.
Yeah. Okay, right. The next batch of funds I want to talk about, Tom, because they do hold prominent positions in all of our lists, are cash funds. We've got the Fidelity Cash Fund. That's at number 2 on our ISA list and number 1 for SIP investors. But there are lots of others too. There's the Royal London Short Term Money Market Fund at number 5 on the list, and the Legal and General Cash Trust at number 10 on the ISA bestsellers list. Among the millionaire investors, the BlackRock Cash Fund is popular, Aberdeen Sterling Money Market Fund, and there's also something called the Royal London Short Duration Gilts Fund, different kind of fund, but sort of similar in some ways. This is interesting. We've spoken about cash funds a lot. I think, Tom, I was thinking, had we been speaking 3 years ago, I don't think we'd have seen any cash funds on the lists.
Yes and no. I think I was thinking about the reason why there are so many cash funds within the bestsellers. I think there are 2 reasons. One is that they are attractive in and of themselves, and I think this is what you're getting at with your question, which is that the reason why they're attractive now is that compared to 3 years ago, interest rates are significantly higher. So you're getting a much better return on your cash than you were 3 years ago. I mean, you're getting close to 5% with many of these cash funds with, pretty much no risk.
Yeah.
Not completely risk-free, but pretty much no risk. And so that's quite attractive. But I think the second reason why we're seeing so many of them in the bestseller list now is that, as you said at the top, we're coming up to the end of the tax year. Many people are thinking, right, I need to get my money into the into the ISA wrapper ahead of the tax year. I don't really know where I want to invest my money. I could just put it in. I could just subscribe to my ISA, and I'll get a return on the cash sitting there. But I'll get a lower return than if I put it in a cash fund. I can't remember the exact figure, but it's 3 and a bit percent compared to nearly 5% in a cash fund. So, and it's very easy to switch between a cash fund and an equity or a bond fund.
Yeah.
So if that's why you're doing it, then it makes sense to park it in a cash fund.
Yeah, they have a sort of functional use, don't they? And I should just say that the list we're looking at, they cover basically 2025, so the last few months of investing decisions. What's the continuing case for buying those kind of funds, Tom? Rates are forecast to come down. Central bank rates aren't exactly the same as savings rates, but they tend to correlate. Inflation is going up. That's something that erodes the value of all investments, but including cash. So what's the continuing case for a cash fund?
Well, I mean, inflation is proving sticky, but in a way that is a reason in itself for investing in a cash fund, because it probably means that interest rates, while they might come down a little bit from here, I don't think they're going to come down very far.
Yep.
Which means we're back to what you might term, the old normal of interest rates being sort of 4 to 5%.
And cash returns being a bit above that. We've not been used to it since the financial crisis, but actually that's the anomalous period.
Yes, and historically that's what cash rates do. They sit slightly above interest rates and slightly above inflation. Over the long run. So I think the reason for holding cash at the moment is what we've already mentioned. It's a safe investment. It's a reasonable return. depending on your appetite for risk and the reason why you're holding money, that might suit your purposes.
Yeah, and I'll save some of this chat, but later on we're going to talk about the absence of bond funds, and maybe cash is sort of part of that story as well. But for now, Tom, next up, this is an interesting one. We've got the Legal and General Global Technology Index Trust. That's number 3 on our ISA bestsellers list, number 5 on our SIP list. But interestingly, this is the number 1 fund among our ISA millionaire investors. It's a passive fund, but it's focused on technology, as the name suggests. So it's a relatively low charge, 0.31%. We do have some other tech funds. We've got the Fidelity Global Technology Fund as well. That's an active technology fund. But focusing on that Legal and General Fund in particular, this is one, Tom, where looking at the performance of that fund, I actually wince a little bit because it's done fantastically well. And it's always the case that you can look back through performance data and say, well, wouldn't it have been great if I'd been in this random fund or that random fund? But of course, you don't know that. You never would have done. You wouldn't have known to put your money. But in hindsight, it was actually pretty predictable over the last 10 years that a technology-facing fund would do really, really well. And it has, hasn't it?
Yeah. And I think that is why it's such a popular fund, because, I think lots of investors, certainly sort of more sophisticated investors, have taken that view that technology is here to stay. It's changing the world that we live in. It's going to be a good investment opportunity over the years. But as with the tracker funds that we talked about before, the global and the US tracker funds, sometimes you just want an exposure to that theme. You don't, you don't actually have a strong view on who's a good manager. Interestingly, the Fidelity one that you mentioned, that is an actively managed fund, and it has also performed
really well,
extremely well. But that is you are making a bet on the skill of that particular fund manager, and maybe you just say, look, I want to have an exposure to technology, and this, as you say, 0.31%. It's a cheap way to get that exposure.
Yeah.
And sorry, one other point I would make actually is that by having a tracker fund within that theme, you are to some extent minimizing your exposure to those big tech stocks which dominate the market. I mean, they will be there, but you're also investing in lots of other technology companies. Yes. It's not just a magnificent 7.
Although it's fair to say
they will dominate that.
They will dominate, and they dominate the top holdings in that trust. Just a point about the difference here: the LNG fund and then the Fidelity fund, one passive, one active, one cheaper, one more expensive. The LNG fund has done better, but I mean, is it the case, or would you agree that it might be the case, that if you're an active technology manager, it's really hard to overweight those big names? It's actually hard to. You're in the business of taking active decisions. Probably your active decisions are going to be to underweight them and look for something else, look for something better value or something shinier and newer. So you'll probably underweight those stocks, and over the past 5-10 years, they're the names that have done the best. So that probably explains some of that underperformance.
Well, yes. I mean, it's an argument with the benefit of hindsight for investing in a tracker, because you've had a market weighting exposure to those well performing funds. Looking forward, that may not be the case, and certainly since the beginning of the year, those big technology stocks have underperformed, and for me, that and we're coming on to my where I'm investing later on. I mean, I am actually invested in that Fidelity Global Technology Fund for that reason. That the manager is looking for technology stocks outside that small group, which are maybe smaller, maybe younger, less mature. They've got more room to grow, perhaps. So if that's the view that you take, if you share my view on that, then taking an active approach might be better.
Yeah, and just finally, before we move on, what's hard, I think, with dedicated tech funds right now, and it has been for a while, is that if you've got say a core of global trackers or what have you, vanilla funds, it just feels like you're really loading up too much on those big names. And I think that would be the case even if valuations weren't as high as they have been.
Yeah.
It's quite hard to do it, isn't it? I mean, lots of people will want to do it, but it would be interesting to know what the holders of this technology trust also have in their portfolio, how they're balancing it out,
Yes, I mean, well, that raises a very important point about looking under the bonnet of your investments and really understanding what you're investing in. Because if you do have a core global tracker and you have this technology fund, you probably are very heavily exposed to those technology stocks.
Yeah.
I mean, there are tools which help you look at the underlying. We call them an X-ray tool. Look at the underlying holdings of your fund, sort of regionally, geographically, by stock, and it's really important to understand what you've got.
Okay, well, the last group of funds I wanted to look at from our best sellers list before we get to your choices, Tom, are there's a small number of blended funds, multi-asset funds. They're all doing slightly different things. We've got a whole host of Fidelity multi-asset funds, something called Allocated Growth, which is number 8 on the SIP bestsellers list. We've got Allocated Aggressive, number 6 on the SIP Millionaires list. Something called Open Strategic. I'm afraid they lose points for too much jargon, but without getting into the ins and outs of each of them in terms of what they're doing, this multi-asset approach, it's not just Fidelity funds. There's an Orbis fund, Vanguard Life Strategy, very famous blended fund. Different things that they're doing, different charges, different levels of risk, but they're blending assets together. What's the case for investing that way in that kind of fund?
Well, the case for investing in one of these funds is diversification, which we talk about a lot as a key investment principle. Putting your eggs in lots of different baskets to give yourself a smoother ride with your investments. So as you say, they'll be invested in shares and bonds and other assets, property, cash, gold.
Yeah.
Infrastructure, all sorts of different things.
On the Orbis fund, there's Orbis Global Balanced. I think the top holding is gold or a gold ETF.
Right, which is quite unusual.
Yeah.
So again, look at what, when you're deciding, even within these balance funds, when you're deciding which works for you, then it's important to really understand, the underlying building blocks of those funds. Just to unpack a bit of the jargon there, you talked about allocator funds and open funds. Those are the Fidelity ones. So the allocator are passive. The building blocks are passive. With the open, the building blocks are more active. So that's different, and there's a difference in cost, which is related to that, obviously. So the basic principle is that you're paying someone else to make the asset allocation for you, to give you the diversification. So they're probably suitable for a less engaged investor, someone that just wants exposure to financial markets. Long-term investor, they don't want to make the choices themselves.
And we spoke about global tracking funds being the vanilla option. They are, but actually being 100% in equities is punchy, isn't it? Really, in the big scheme of things, that's actually quite an aggressive and relatively risky choice, because equities are the riskier end of the investment world. These multi-asset funds will have...
They are at the more volatile end of the investment world. Now, that's not quite the same thing as being risky, depending on your time scale, because over time they have delivered better returns. So that's a bit of a nuance, but it's quite an important one.
Fair play.
Yeah.
But these multi-asset funds will have assets that are there to diversify from equities, and therefore, if they work, protect against downside risk. And so, if that's you as an investor, these are quite attractive, aren't they? Because again, you don't have to make the decisions. You're going to get a bit of these different assets, hopefully a slightly smoother ride.
Yes, you will almost certainly get a smoother ride. You'll have the falls will be less severe, but equally the rises will be less extreme as well. But the price that you will pay for that smoother ride is that your long-term returns will probably be more pedestrian.
Yeah.
And if that's what you're looking for, if that's the combination of risk and reward that you're looking for, then great.
Absolutely. And I mentioned that we haven't got any dedicated bond funds among the best sellers list. I'm sure there's plenty down the list. But any exposure that people have to bonds amongst these best-selling funds, they're accounted for, aren't they, by the weightings to bonds within these multi-asset funds. That says something about how people feel they need to diversify, and it's not just with a bond fund.
Yes, and I think that there is an argument for having broader diversification than simply through bond funds. I think it's interesting, though, and there's a bit of a digression here, but I think it's interesting that the bonds don't feature on our bestseller list, and I think that a lot of people, I probably include myself in this, just don't feel as comfortable in terms of our understanding of bond funds than we do with equity funds. So I do think that individual self-directed investors are probably more heavily weighted to equities than maybe they should be, and certainly more heavily weighted to equities than they would be if they were being advised. I think an advisor would probably give you a more balanced portfolio. And
it's both those things. It's a sort of a sense of lack of. I have this as well with bonds. A sense of lack of visibility. I can't truly understand and predict how they're going to move. I know inflation affects it. I know that rates affect it, but they didn't always do exactly what you think. But if they were doing really well, I could probably look through that.
Yes.
And the fact that they're not is,
and I think, and I think that is a reflection of the period that we've been through. Since the financial crisis, stock market shares have broadly gone up. They've outperformed bonds. So I think the temptation is to extrapolate the recent past into the future. Of course, the time when you really need bonds and the lower volatility, the smoother ride that they provide, the income, is precisely at times like this when they've not been performing well in the past.
Yeah. Okay. I'll just say here that we've gone through loads and loads and loads of funds already. All these funds are gathered together in a couple of different articles, but if people just look for investment ideas, Fidelity, they will find all these articles. And they will also find, Tom, your own choices for the end of the tax year. Regular podcast listeners will have heard us talking about your choices in the past few weeks and months, but we can restate them here. Where will you be putting your money this time, Tom?
So I recently wrote an article which you can also find on the website, which I called 10 for 10. This was the idea there was 10 funds that I would hold for 10 years. And I just need to caveat to start with. For one thing, first caveat is this is just what I'm doing.
That's right.
Again, as you said at the beginning, I'm not advising people at all that this is what they should do with their investments. The other caveat I would say is that if you look at the 10 funds on this list, you might think, well, that's quite a punchy, quite an equity heavy, it's not completely, but you might think that's quite an aggressive approach. And so my caveat is that I also have some money elsewhere in cash, so this is not all of my money. And I think that's an important point to make. Having said that, so what I did was I broadly divided it up into 5 pairs. And they covered off growth, value, defensiveness. I also wanted to hedge my bets on the question of whether the US was going to continue to lead the market or whether other markets were going to do it. That's been a very interesting question over the last 3 months. And finally, I because this is a 10 funds for 10 years, I wanted to, have a nod towards the fact that the world is changing and what are the themes likely to be over that 10-year period. So running quickly through them then, the growth funds, Rathbone Global Opportunities.
Yes, which was amongst the bestsellers as well.
Yes. Yeah, that is a very popular fund. It has done extremely well. high exposure to the US,
More tech.
and more tech. So so it's not had a great run in the last couple of months. You would expect it not to have done. This is a 10-year investment.
Mm-hmm.
Very, very happy to hold that. Brown Advisory, US smaller companies. Again, not been particularly successful in the last since I wrote that article. But again, over the long run, I want some exposure to the US. I mean, yes, the US may have gone a bit too far, and what's going on with the trade situation and tariffs is making people nervous about the US economy. Over a 10-year view, I want some exposure to the US, but I kind of wanted to steer my exposure away from that more expensive corner of the market. It felt to me like smaller companies, over the very long run, smaller companies have the opportunity to grow faster than bigger companies. Elephants don't gallop, as they say. It's a well-run fund, and I'm confident about that over the long haul.
Mm-hmm.
Looked at value. Growth has had a very good run. Funds focused on high earnings growth have been popular, and they've done well, partly because of that tech story. The pendulum swings in investment, and I wanted some exposure to the sort of less popular, more value-focused funds. The two I chose were, one's a Fidelity fund, the Fidelity Global Dividend Fund.
Yes, also amongst the bestsellers, this fund.
Very popular fund for good reason. It's provided a very smooth ride. It's quite a concentrated fund. Dan Roberts, who runs it, has a real focus on quality. It's a risk averse fund.
And we've spoken about this fund a couple of times before. It would be called an equity income fund, but equity income in the global context, it's not quite the same as equity income in the UK context, where you would expect 4 to 5% of income, more like 2 to 3. But the companies producing that income are generally increasing their dividend payments, and that's what the manager looks for, right?
Yeah, so he's not looking just for a high initial dividend, which is probably an indication of a company being out of favor, being lowly valued. What he's looking for is, as you say, dividend growth. So he might start with a 2 to 3% dividend, but if it's going to grow, if it's going to be increased year after year after year, then that becomes very interesting as it's rolled up over the years, and that's what he's looking for.
Okay.
The other value focused fund is the Dodge and Cox Worldwide Global Stock Fund. So this is another global fund,
active fund,
actively managed, and deliberately skewed away from the US, not massively. So I said earlier on that the US represents about 70% of the value of global stock markets. I think that this fund is about 50% in the US, but the types of companies that it invests in the US are different from the big highly valued stocks which dominate the tracker indices. So that's the value. Then again, I wanted some sort of defensive-ness in this portfolio. No one knows what the future holds, and you need a bit of balance. We talked about those balance funds before. That I've created that balance by introducing some of the things which those balance funds invest in: gold and infrastructure. I did the gold in a pure vanilla way, just through an ETF.
A physical gold ETF.
The iShares physical gold ETF simply buys gold. There are other ways of doing it. You can invest in the miners, for example, but then you start introducing equity risk and operational risk, whereas this is a pure play on gold.
And I'll take your point. You'll make the point about this being for 10 years, but it's also true to say gold funds of all kinds have been amongst the best performers this year. That means you're buying gold at a high level.
Yes, I mean the gold price is at a near all-time high, but over the years it has proved to be a very valuable diversifier within a portfolio. It's performed extremely well over the long haul. Doesn't always there are long periods when it doesn't perform well, but this is a long-term portfolio, and so I'm prepared to hold it, through thick and thin. The other one, the infrastructure fund, is actually an investment trust. It's called International Public Partnerships. It's got more of a UK focus, actually. It's a kind of bet on the new-ish Labour government meaning what it says about investing in the fabric of the British economy and making us more productive. It invests in assets which are key to they're essential parts of the economy. So schools, hospitals, roads, renewable energy, the nuts and bolts of a modern society. It offers a very high and attractive yield. It's grown its dividend every year for nearly 20 years now. And actually, for various reasons which are related to the fact that it's an investment trust, it's available. You can buy the shares for a lower value than the book value of the underlying assets. So that is also
makes it attractive. Yes.
Okay, that's 6 of them. Then I talked about this question of, is the US going to continue to lead markets or not? I genuinely don't know the answer to that question. We have seen a rotation so far this year. In the long run, that may not be the case. The US is a dynamic, powerful economy. I suspect it will continue to lead markets. So I've sort of hedged my bets a bit there by having, again, a low-cost tracker. But this one, again, deliberately weighted against away from the most expensive parts of the market. So it's the iShares S&P 500 equal weighted index. So what this does is it buys the 500 shares in the S&P 500, but not in the normal way that a tracker fund does, aligned to their value. So it invests more money in the biggest stocks. It invests equally in 500. So
you've got the same amount
0.2% in each of
the same amount in Apple as you've got in the 500th company.
Exactly right. So that's that. And then on the basis that the US may not continue, I thought, well, let's have a look at one of the more attractively valued markets. The UK definitely falls into that category, and I've gone to the other extreme. I've gone for an actively managed, quite a contrarian fund, the Fidelity Special Situations Fund. Well-known fund. Many people listening to this will be very familiar with that fund. Of course, it was famously run by Anthony Bolton for many years. Now run by Alex Wright. So that's the US rest of the world question, and then finally, I wanted to address this changing world over the next decade. And so we've talked quite a lot about technology, and I mentioned that I'd invested in the Fidelity Global Technology Fund, so that's one of them. Don't need to repeat what I said there. And then the final one of my 10, and the second sort of changing world theme is that there is an ongoing shift from the developed world to the emerging world, or at least the emerging world is catching up with the developed world. And a really good way of getting exposure to emerging markets that's done very well, and I think it's a very well managed fund, is the Lazard Emerging Markets Fund. Again, an actively managed fund.
Okay, well, Tom, that was a tour de force. Thank you. And it is just about all the time we have for now. I'm going to point people again to the website where they can get details on all the funds, every single one that we've spoken about. You'll get details for and links to at the Markets and Insights section at fidelity.co.uk. But for now, Tom, thanks for joining me.
Thanks, Ed.